Hey guys, how's it going? It's Andy from Magoo Investing. Today I'm going to be making a quick video kind of explaining why I really enjoy buying stocks after they have a bad earnings report or just bad news in general. So I go back to over winter break back in probably mid to late December of this past year. There were three stocks that came into mind when I thought of having bad earnings or bad news, and that was Apple, Procter & Gamble, and Costco. These were all three really well-known stocks, a lot of volume being traded, and they had some bad news. Apple, they weren't going to be selling as many iPhones as they previously thought. Costco with bad earnings, and then Procter & Gamble with a lawsuit with the baby powder. So these are all three catalysts that made it so that people that were holding the company at that point thought it was a reason to jump ship. And the reason that stocks move is because investor sentiment changes. So people aren't thinking as highly of the company anymore, and the stock price shows that, so it dropped. And so the reason I really enjoy buying after a stock has bad news is people overreact. And so if you're sitting there and you're a normal person and you see the stock that you own drop 5-10% in one day because of a bad news story, you're most likely going to be thinking about leaving that position. And so many people do that, and it just keeps pushing the stock lower and lower. And so while the news might not have been that bad, the reaction from investors pushes it further down than it really should be. And so in the next couple days, weeks, even months after that, people go back and they analyze the company and realize, you know what, this was kind of an over-exaggeration. This is still a good company. So with all three of these companies, Apple, Procter & Gamble, and Costco, if you had entered those positions right after those bad news, you'd be up 10 to 15% depending on which one you entered. So this is something that I do in my overall trading strategy. I tried doing this recently with GameStop, did not work out. But I had my plan. I'm sure if I sat in there for a little longer, it would have turned out better. But these are just kind of three of the big stocks, three companies that pretty much everyone knows about, as kind of an example of why having bad news isn't necessarily a bad thing for the company. It could be that maybe they're changing their focus. Maybe investors were kind of, they over-anticipated how much money the company would be making, even though they could still be profitable. Earnings, as I mentioned in my last video, are kind of dangerous because it's not just whether or not the company is doing well, it's how well they're doing compared to what investors expected them to do for this past quarter or past year. So just something to think about. It's probably one of my favorite strategies to use. One of the variants of this is called the pinball strategy, which I'll make a video about in the future. It's more technical. I'll have to be using the computer for that, but still need to go study for some midterms. So this is kind of a quick video that I could put out, kind of explain what my overall trading strategy is, and kind of make you think about, we have these companies like Heinz that have these horrible earnings, and just kind of show that while things aren't looking good right now, a couple months from now, you might have been able to buy this at a great discount. I don't think that's the case with Heinz, but just kind of putting that in your mind that if you see this company, well-known company, have bad earnings or bad news, it might not be as bad as you think, and you might want to take a look at investing in it. So hope you guys enjoyed this video. If you did, please hit the like button, and I will see you guys in the next video.